When companies look to expand into Denmark, one of the most critical and often misunderstood elements of cross-border trade is the role of the importer of record. In this video, we will walk through exactly what the importer of record is, what responsibilities it carries under Danish and EU law, and how you can structure your operations to stay compliant while managing risk and cost effectively. Our goal is to give you a clear, practical roadmap so that when you ship goods into Denmark, you know who is accountable, what they are accountable for, and how to avoid the most common pitfalls that can delay shipments, trigger fines, or damage your reputation with authorities and customers. Let us start with the basics. Denmark is a member of the European Union and part of the EU Customs Union, which means that customs rules are largely harmonized across the EU. However, the importer of record, often referred to as the IOR, has obligations not only under EU customs rules, but also under Danish tax, VAT, and product compliance regulations. The importer of record is the legal entity responsible for ensuring that goods imported into Denmark are correctly declared, fully compliant, and that all applicable duties, taxes, and fees are paid. This is not just an operational role, it is a legally accountable position. If there is a mistake, the importer of record is the party the Danish Customs and Tax Administration will look to for answers, back payments, and potentially penalties. In many cases, the importer of record is the local Danish subsidiary of a multinational company importing goods for resale or internal use. In other cases, especially when a foreign company has no legal presence in Denmark, it may appoint a third-party logistics provider, customs broker, or specialized IOR service provider to act in this role. Regardless of who it is, the responsibilities are the same, and they are substantial. From a customs standpoint, the importer of record must ensure that all shipments are correctly classified using the harmonized system and the EU combined nomenclature. This classification is what determines the level of customs duty, whether any trade defense measures apply, and whether licensing or additional controls are required. Misclassification, whether accidental or deliberate, can result in underpayment of duties, post-clearance audits, and retroactive assessments. The IOR must also ensure the correct customs value is declared. This involves more than just the invoice price. It may include freight, insurance, certain commissions, and potentially the value of assists, such as free tooling or design work provided by the importer. Incorrect valuation is a common area of dispute with customs authorities and can quickly translate into significant financial exposure. Beyond classification and valuation, the importer of record must determine the origin of the goods. This matters because origin drives eligibility for preferential duty rates under free trade agreements and whether specific restrictions or sanctions apply. For example, if your supply chain sources components from multiple countries, the IOR needs robust documentation to substantiate the declared origin and to prove that any preferential treatment claimed is valid. Failure to do so can mean repaying duties with interest, and in serious cases it can trigger allegations of customs fraud. In Denmark, as across the EU, import VAT is a major consideration. Typically, VAT is due at the time of import, and the importer of record is responsible for ensuring that the correct VAT amount is calculated and paid or accounted for. Many businesses use postponed accounting mechanisms or VAT deferment schemes to manage cash flow, but these options usually require proper VAT registration and compliance with Danish tax rules. If you select a local partner to act as IOR, you must have clarity on who is responsible for reclaiming or offsetting import VAT and how that aligns with your broader tax structure. In addition to customs and VAT obligations, there is a comprehensive set of product compliance responsibilities. The importer of record must ensure that the products meet all applicable EU and Danish standards, ranging from safety and environmental regulations to sector-specific rules. This can include CE marking for many industrial and consumer products, compliance with REACH and RoHS for chemical and hazardous substances, eco-design and energy labelling requirements, and sectoral rules for products such as medical devices, food, cosmetics or electronics. The IOR must be confident that technical documentation, test reports, declarations of conformity and labelling are all in order before goods are placed on the Danish market. If authorities identify non-compliant products, they can require recalls, impose fines, or even ban the products from sale, with the importer of record bearing the primary responsibility. Accurate and complete documentation is central to all of this. The importer of record must retain commercial invoices, packing lists, transport documents, customs declarations, classification rulings, certificates of origin, and any licenses or permits for the legally required retention period, which under EU rules is typically several years. These documents must be readily available in the event of a customs audit or inspection. Weak documentation practices are one of the fastest routes to extended audits, delays and assessments. Equally important is the requirement to work with qualified customs brokers and logistics providers. While the importer of record can delegate operational tasks such as filing declarations or arranging freight, it cannot outsource legal accountability. The IOR must ensure its service providers are competent, that instructions are clear and accurate, and that there is oversight and periodic review. A strong governance model might include standard operating procedures, clear authorization matrices, regular data quality checks on customs entries, and periodic internal audits. For many companies, a key strategic question is whether to act as their own importer of record in Denmark or to use a third party. Acting as your own IOR gives you maximum control and transparency, but it requires local registration, in-house expertise, and the capacity to manage ongoing compliance. Partnering with a third-party IOR can accelerate market entry and reduce administrative burden, but it adds complexity in terms of contract structures, liability, and data access. Whichever model you choose, it is essential to define responsibilities in detail. Who handles classification? Who manages licenses? Who keeps records? And who responds to audits and inquiries from Danish authorities? These points should be reflected contractually, supported by clear KPIs, and aligned with your overall risk appetite. You should also consider the interplay between Denmark and the broader EU. Once goods are in free circulation in Denmark, they can move across the EU without further customs formalities, which makes Denmark an attractive entry point for regional distribution. However, this also means that any errors at the point of import can propagate through your entire EU supply chain. For example, an incorrect classification used consistently on imports into Denmark can lead to underpayment of duties not just in Denmark, but everywhere those goods are sold. It is therefore critical to treat Denmark not as an isolated jurisdiction, but as part of your integrated EU trade and tax strategy. To manage risk proactively, leading companies typically invest in three areas. First, they establish robust master data for products, agreed HS codes, origin, and customs values that are centrally maintained and reviewed. Second, they implement process controls, checklists, system validations, and approval workflows for shipments into Denmark, especially for high-risk categories such as controlled goods or high-duty items. Third, they build capability, training internal teams and aligning with external advisors to ensure they stay abreast of regulatory changes, whether at EU level or through Danish implementation. Regular interaction with your customs broker, tax advisors, and legal counsel can prevent issues before they arise. Looking ahead, digitalization and data transparency are increasing regulatory expectations. Danish and EU authorities are using advanced analytics to identify anomalies in trade data, meaning that inconsistencies in your declarations are more likely to be detected. The importer of record must be prepared for more data-driven audits, shorter response timelines, and higher expectations around traceability and governance. Investing in systems that integrate ERP, logistics, and customs data is moving from a nice-to-have to a basic requirement for sustainable compliance. To conclude, acting as importer of record in Denmark is not simply a box to tick on a logistics checklist. It is a substantial legal and operational commitment at the intersection of customs, tax, and product regulation. The importer of record is responsible for accurate customs declarations, correct calculation and payment of duties and VAT, full product compliance, and robust record keeping, all under the scrutiny of Danish and EU authorities. By clearly designating the IOR, defining responsibilities, investing in data and processes, and working with the right partners, you can turn compliance from a source of risk into a source of competitive advantage. If Denmark is, or will be, a key gateway for your European operations, now is the time to evaluate your importer of record model, close any gaps, and ensure your business is set up for compliant, efficient, and scalable growth.